Today, I want to walk through how the United States can actually export its inflation. This is not something that you're going to hear in a university economics degree. It's an interesting way of looking at how the Fed creates money and actually spreads inflation around the world, given that the US dollar is a global reserve currency. So, I want to walk through first, how a single dollar flows through the economy from import and export point of view, and then look over the entire world economy and how that flow makes the dollar's inflation move to different countries because of how countries interact with the dollar that's different from other currencies. And then we'll look at the data and events and see if this thinking holds up. Does the United States creating more money actually cause inflation in other countries? So this question was sparked for me by 2008 and now 2020 when the US authorities started creating more and more money. So the Fed likes to talk about a shortage of dollars across the economy or across the world. I think that's really interesting word choice given that dollars don't do anything productive. So there can't really be a shortage of dollars in the same way that there can be a shortage of food or housing or other real goods that people need to stay alive. Dollars are just a medium of exchange and a store of value for people. They're not a thing that you consume in and of itself. So in this case, there are just people who cannot pay debts. So what the Fed does is they print money to allow those people to then pay down their debts and pay the next person that they owe so that that person can pay the next person and so on and so forth. And all that really does is transfer wealth from those who have savings or live on a fixed wage to those who are systemically in debt, which is large corporations and the US federal government. You might think your credit card debt is bad, but try living your daily life with debts that are 20 times the size of your assets. That's what a lot of banks and corporations do every day. So they're very, very indebted, and this money printing helps them then pay off those debts. But the end result is a lot more money is in the economy. So if they're going to pay off debts, that can lower the supply of money. But if you're looking at the overall, what's called the M2 supply of money that we'll look at later, that M2 tracks both money being destroyed by paying off debts as well as money being created by more lending and credit card payments and whatnot that actually does create money, as well as the Fed creating more reserves that creates money out into the economy, and that's what can trigger inflation. So you would think if more pieces of currency circulated, prices might go up, right? If you create more money, you get inflation. At least that's what's steadily happened over the past century as the amount of dollars in circulation has increased. The Fed knows this, the government knows this, we know this intuitively. However, one really interesting thing is we did not see high inflation after the financial crisis of 2008. And even now in 2020, although we should probably wait a few years before we talk about whether all of the money printing in 2020 created inflation. So looking after 2008 or before that, after 2001, when interest rates were lowered, where did all this money go that was created? Well, I want to show you how some of it actually went abroad and caused inflation abroad. So while we didn't see high inflation in the US and consumer prices after 2008, we actually did see high inflation in a lot of countries abroad, and especially in emerging economies. So the first thing I want to talk about is just a simple model of how a dollar flows when you're importing and exporting. The first step is an American entity, such as an individual or a company, buys a foreign product using credit. So new dollars are created when that credit is created. Those new dollars then go abroad, and the foreign product comes to the US. The foreign entity then trades those US dollars for their local currency so that the foreign entity can pay their workers or pay for their own food or whatever they need to pay for. So when you look at that from a country level, if you say you have country A and country B, if country A is exporting more to country B than they're importing from country B, you have a net flow of goods from country A to country B and a net flow of currency from country B to country A. The effects of that then, as you'll learn in any economics 101 course, is that currency of country A appreciates relative to the currency of country B. Country A then has exports which are more expensive, so the exports decrease. Country B then also has exports that are cheaper, so their exports increase. So this leads to a natural balance. If a country is exporting more than they're importing, their currency becomes more expensive, which then causes exports to be more expensive from that country, and then their trading partners buy less of those exports, and naturally the exports come back down and the imports come back up. The reverse happens if imports are too high and exports are too low, the currency devalues, and then that changes. So what changes this and stops this natural balance from occurring is manipulation of currency. And the US is one of the best in the world at doing this because the currency is so demanded around the world to pay off US dollar denominated debts and to pay for oil and other things that are denominated in US dollars on global markets. So to create a persistent trade imbalance where country A always has higher exports relative to country B, so there's always more goods flowing out of country A into country B and more currency flowing out of country B and into country A. A great example of this is if country A is one that's dependent on exports, like a lot of developing economies are. That economy, for its own reasons, cannot allow export prices to rise because if its exports become more expensive, then other trading partners will buy less of those exports and their export dependent economy will suffer. So all those companies that are exporting things will be able to sell less and less and their growth will go down, their economy's growth will go down. So what country A then does is their central bank, when they're getting more and more currency from country B and people in country A are taking that currency to banks and exchanging it for local currency, the central bank also has to print more local currency when country B's currency comes in. That way, they can keep their export prices low. They basically devalue their currency because if they allowed their currency naturally to rise in value versus the other country's currency, then suddenly they'd find their exports are more expensive and all of those effects they don't want to happen will happen. They need to print more of their local currency and circulate it. When more local currency is circulating, it means there's inflation for the locals in that country. But they get this persistent trade imbalance, so there's more exports. So basically, country A, instead of allowing the effects of this trade imbalance to naturally balance and rise their imports and lower their exports, they're keeping the trade imbalance and they're just pushing the effect into the inflation of their currency. So there's always going to be this natural market effect that will push down exports and push up imports. They're just choosing to devalue their currency, and instead of allowing that imbalance to correct, they're just pushing it off into inflation. So you'll see their currency inflate. Where you get really high inflation then is when country B is a country like the United States. So the United States runs a trade deficit. They're always importing more than they're exporting with most of their trading partners. That means they're pushing US dollars out abroad to other countries. Then those other countries are having to print more and more goods. And what the US often does is buy on credit. So they're printing a lot of dollars. Those dollars are ending up abroad. And then that's forcing central banks abroad to print more of their local currency. When the US prints, instead of dollars being printed in the US and then causing higher prices in the US, they're printed in the US and then sent abroad, which then causes those countries abroad to print more, and then those countries experience higher local inflation. That's how that inflation gets pushed off, because those new dollars are pushed abroad, and then that's mirrored in those countries having to raise their supply of money. That causes high local inflation. So this is just illustrated visually here. There's a world trade imbalance between the US and a lot of other countries, and it exists, I'm sure, in many other countries, but the US is one of the largest ones. The US economy is 70% consumer spending. So consumers are buying things. A lot of these things are imports from abroad. they're sending their dollars and their currency abroad. They're sending these pieces of paper abroad. Foreign countries are sending cars and computers and oil and all these other consumer goods to the US. Because all those dollars are leaving, if our trading partners want to keep their export prices low, like say China, for example, those countries are forced to, in some way, shape, or form, print their local currency. So when the US has higher imports, they're buying on credit. That accelerates the rate at which those foreign central banks must print local currency. So it's really important that we look at the data and try to suss out whether this effect is actually happening. So the first thing we need to look at is, does the US import more than it exports? This is really important because in order to see inflation occurring, you need to have a situation where there's an imbalance that needs to be corrected. So is the US really importing more from the globe than it's exporting? And because of that persistent trade imbalance, there's more money and cash, US dollars, flowing out of the US, which then causes foreign central banks to have to print in order to keep their export dependent economies running. And that causes that local inflation. The second question we need to look at is, do major credit creation events in the US, so when there's more money printed, does that lead to inflation in emerging economies? And for that one, I want to look at a specific case in the Arab world and illustrate how this is actually happening. So as far as a US trade deficit, it has been growing since 1971, which is ironically the year that the US government left the gold standard and the government gained more power to print dollars at will. So they were no longer limited by the amount of gold that they had in the treasury. They could just print as long as they could find paper or cotton, as dollars are actually made out of. Now all they need is to type a couple zeros into a computer. As long as they can create more dollars, they can run a trade deficit. So as you can see, it looks small there around 1971, but that's where the trade deficit really pops off of zero. And then by 2000, it is sending super far south, which means a lot of dollars are being sent out abroad and hard goods are coming into the US. Looking at the money stock, which would be credit creation, so dollar supply has been steadily rising really since 1913 when the Federal Reserve was created. But 2008 and 2011 were big increases. In 2001, interest rates were lowered quite a bit, so that also allowed an expansion of credit. So we're going to look at those in a specific case in the Arab world and see how that money creation could be creating inflation. So this is just another way to visualize money creation in the US. This is the annual percent supply change. This is the this is the annual supply change, and it's plotted with monthly points just to give you a little more fidelity. And this reveals more spikes. So you see a spike in 2001 of money creation, you see a spike in 2008, and there's a spike in 2011 as well. And then there's an astronomical spike in 2020 as a result of all the coronavirus reactions. The specific case that I want to look at to illustrate how the US exports inflation is Arab countries during the Arab Spring. So I've plotted out here the inflation rate in 5 different Arab Spring countries, or 6 different Arab Spring countries: Egypt, Libya, Syria, Yemen, Tunisia, and Bahrain. And I've adjusted all of these numbers to their GDPs over time. So Egypt and Libya are strongly represented, and then Yemen, Syria, Tunisia, Bahrain have smaller GDPs, so they're less represented in the inflation rate. But you can see that there are big rises starting around 2001, and then there's a big rise right in 2008. And then the Arab Spring actually breaks out around 2011. In a developing economy, if you're living right at that margin and suddenly food prices are starting to accelerate, that can be really, really, really dangerous for just political stability and can create a lot of unrest and violence. And this isn't price levels here, this is inflation rate. So the inflation rate is actually increasing and then staying high around 8%. Around 2011, 2012, 2013, we saw all those riots and all that unrest. and then actually spiked up further than that. And now Libya, for example, is somewhat of a failed state. Egypt is not doing so well. Syria and Yemen, we know, are not in a good place. If you look at US dollar creation and the correlation to inflation abroad, I've looked at the M2 annual percent change here. So M2 is inclusive of Federal Reserve money, so like actual physical cash, as well as bank reserves and money in bank accounts. So it's a good measure of all the dollars that are flowing around in the economy, probably the best measure that we can get. And it's from the Federal Reserve. All the data that I've used throughout here is from government agencies. The annual percent change, I've shifted it 5 years forward because it takes a couple years for this money to be disseminated out into the economy and to start actually affecting prices. And then I've put that next to the Arab nations' inflation rate. So you'll see around 1998, 1999, 2000, that's when money creation in the US starts to pick up the pace and hit 5-8% per annum. That's exactly when Arab nations' inflation rate starts to go up, and then it peaks around 2008, stays high around 8% as the US continues to print heavily, and then takes off again in 2017. So as these dollars are created, it's not an exact correlation because they aren't literally created and then sent to the 6 Arab nations that I've picked here as an example. They're going to all different places around the globe. Sometimes they're hoarded in the US for a while and then sent abroad. So it's not an exact correlation, but you can see that as the acceleration of money printing occurs, you also get an acceleration in the inflation rate abroad. So we may have seen 2% inflation from 2008 onward in the US, but this explains where some of that new money was going to, that new currency that was created. So that's my spiel about how the US exports inflation abroad. If you want more detail on this story to better understand how this process works, go to whatismoney.info/dollar export. The link is also in the description below. Check that out. Let me know what you think. Drop a comment. Thanks so much for listening.